Now that we've taken care of the intricacies of proper trading system design, it is time for us to turn our focus to the second pillar of trading success, money management. If you're tired of the cookie-cutter rules and non-actionable supposed secrets that leave you more confused than you were prior to hearing them, then this video is for you. I will be walking you through the realistic purpose of risk allocation as used by someone who actually trades for a living. I will show you exactly in what way you've been misled by mainstream pseudo-trading knowledge, and especially, precisely what hands-on process you should adopt in order to make an actual difference in protecting your capital. So let's strap in, it's time to harness this core concept and put it to rest once and for all. Let's clear up the field first. Given the crap spread out over the internet, it is essential to wipe the slate clean and reframe your preconceived idea about what money management actually is. Contrary to what you've been told, and despite some loosely overlapping notions, money management and risk management are two completely mutually exclusive trading concepts. While risk management focuses upstream on maximizing the expectancy of a trading strategy, money management, on the other hand, applies downstream of your trading process and aims to astutely dial your capital deployment in a way that fits your subjective risk aversion as well as objectively minimizes your risk of ruin. Another way to wrap your mind around it is to think of risk management as an offensive process which primary purpose is to maximize net risk-adjusted upside, whereas money management is a defensive process which aims to allocate your capital according to that risk management in order to protect your downside and survive to trade another day. As I will explain it further along this video, whereas risk management leads, money management follows, and not the other way around. Even if this nuance sounds very abstract at first, its misunderstanding is the source of much confusion and trading catastrophes. The reason why retail trading culture tends to conflate both is that most retail traders lack a clearly articulated trading process, let alone a firm and quantified grasp over the expectancy of their strategy and the intrinsic risk embedded in it. So naturally, both risk management and money management are perceived to be one and the same, simply because their money management is effectively the entirety of their risk management, which they do not have any clue about. From this confusion, a myriad of misconceptions and false promises are born. The most glaringly absurd of which is the affirmation that money management can turn your strategy's expectancy around. In other words, that it is some sort of holy grail of trading that can single-handedly turn a losing proposition into a winning one. This is provably flawed right at the mathematical level. If it were true, then unlimited martingale would have minted thousands of billionaires by now. Money management obviously cannot substitute itself to the actual statistical edge obtained through proper strategy design. It sure can temporarily create the illusion of performance for a while, but it will never be enough for a strategy with an inherently negative expectancy to avoid the final outcome of total ruin, which will often be precipitated in its final days. Once you have accepted that fact, you understand why money management is nothing but another way of calling capital allocation, meaning a second layer that stands on top of risk management. The only goal of money management is to make sure that the bankroll attached to your strategy is anti-fragile. That's it, nothing more. It is a layer that is a necessary condition of long-term profitability, but certainly not a sufficient condition of trading performance. Said differently, if it sure can break your trading success if done wrong, it alone sure as hell cannot and will never make it. The statements that I just made are miles away from the so-called no-brainer rules plastered all over social media, which leads me to itemize to you the worst ones so that you can discard them once and for all and we can move on to doing something constructive with that knowledge. 4 main categories can be identified that will do nothing but harm your bottom line, and potentially even more so than having no money management at all. As you will see, what all of these have in common is that they myopically focus on single trades rather than the entire trading system, and for a very good reason, which is that, as I just explained it, most people do not have any working strategy to start with. So logically, all that they have left to manage are single trades which end up behaving like headless chickens with no coordinated rhyme or reason with one another. The first category is the blanket position sizing scheme that instructs you to risk a fixed percentage per trade. This does not and cannot work because it operates in a vacuum that is totally out of touch with both your strategy's peculiar risk-adjusted characteristics and your own risk aversion. This is the best way to either wreck your bankroll because your trade size unknowingly overstressed your actual strategy's max drawdown into a margin call, or to overshoot your own risk aversion and make you crack under pressure into a panic trade. The second category is the money management scheme relying on the tweaked entries and exits. The most popular in this litany of nonsensical advice has to be the use of trailing stop orders or stacking scaling orders, which will almost always have the direct effect of dramatically reducing your expectancy for the short-term benefit of soothing your stress level. In almost all cases, this type of feel-good advice comes with zero quantification of its impact on your strategy's expectancy. But just move your stop to break even, bro. Does that sound familiar yet? The third category now encompasses all the schemes that rely on the reward to risk ratio. In other words, I will set my limit and my stop loss at say 2R, so then I'm gonna shoot to make twice what I stand to lose on each trade. Sounds like genius. Why didn't I think about it already? Well, maybe because the probabilities will adjust themselves accordingly. What this type of short-sighted reasoning shows is a profound misunderstanding of the concept of expectancy as a whole, which I have purposely explained in this video very early on in our educational series. And for a good reason. Relying on risk-reward alone is the evil twin of this other similar belief that you will make money by being more than 50% right on your trades. Same flawed logic. And lastly, the fourth category is more subtle but equally harmful. It is this idea that you should be recursively adjusting your position size based on short-term volatility. While this may be applicable at the broad portfolio level based on a particular investment universe, whereby you would be trading smaller positions on high volatility Nasdaq stocks than on low volatility S&P 100 stocks for example, it is straight up impossible to do consistently on a trade-by-trade basis. The flawed premise here is that attempting to do so will add another highly unstable random variable to your system, and one that is arguably the most non-normally distributed of all, which is volatility itself. The only thing that you will achieve in this exercise is not only to mess up your money management, but most likely to screw up an otherwise perfectly viable trading system, assuming that you have one at your disposal. So please don't do it. Now, diving into the implementation of capital allocation, we need to focus on the first building block that is absolutely required to make money management work as intended. This one practical aspect cannot be objectively determined, but it can be deterministically quantified. I am talking about risk aversion. Along with your profit target expressed in currency terms, which everybody can easily guess in a heartbeat even if it's not always realistic, risk aversion is possibly the most intricate and only subjective ingredient that you will ever be asked to add to your strategic plan as a quantitative trader. Only you can know it, based on your own gut feeling and tolerance to the psychological pain of seeing losses pile up and your capital melt down. The best metric to quantify it is the concept of maximum drawdown, which is the maximum expected loss that your system will incur before making a new high at any point during its life cycle. However, as I said, if only your subjective appreciation can determine what your own tolerable max drawdown is, we can absolutely quantify it in the form of a percentage. So for example, a 25% max drawdown means that you have accepted and made peace with the fact that you might lose a quarter of your peak capital before making money again. If you still have trouble envisioning what a tolerable max drawdown should be for yourself, here is a generic order of magnitudes for maximum risks that most clients would typically require from their active money manager. In general, 10 to 15% is considered conservative, while 20 to 25% is considered moderate, and 30 to 35% is considered aggressive. There is a reason why you would not want to exceed 35% in most cases though. That reason is described by the asymmetry of percentage loss versus recovery rate. As you can see on this graph, the percentage return required to recover from an X% loss is anything but linear. The more you lose, the greater the extra effort that needs to be made in order to get back to square one with your capital's previous high. I kept the scale of the max drawdown to 75% because it becomes stupidly steep after that, but you get the point. The recovery effort is exponential. For example, for a drawdown of 15%, the required recovery is plus 17.65%, so about on par. But for a drawdown of 35%, full recovery requires almost a 54% return, not the same ballgame. And for a 50% drawdown, full recovery requires a staggering 100% return. So pause here, take a harder look at this chart if you need to, and decide what kind of drawdown would keep you up at night. The rule of thumb is that if you have to merely think about it when you go to bed, then you are already past your pain point, your risk aversion is actually greater than you think it is, and you should scale back as soon as possible on your risk appetite. Now here comes the second and hardest building block about money management. There is a very strict logical order about how it should be implemented. There is a start and there is an end to the process. And the starting step is the biggest hurdle that most will not be able to pass, which also explains why so many new traders go bust so quickly. This hurdle is that you absolutely must have some semblance of a thoroughly tested trading strategy, while the max drawdown can be reliably quantified, at the very least statistically on an historical basis. Now keep in mind that you can even raise your game from here, as there is a way to further refine your quantification of max drawdown that goes beyond a simple backtest, but it is past the scope of this video. Regardless, as a starting point, if you can't quantify your max drawdown at all, then you may as well just forget about money management. I wish I could tell you otherwise, but unfortunately, there is no way around it if you want to make it work, and I will not blow smoke up your ass like other trading channels. That is just the way it is. Blame math for it, not me. I just don't want to waste your time. But if you do know your max drawdown, then the workflow is as follows. You should first calculate your strategy's reward to risk profile with zero leverage applied, normalize it if you have to, and then bind it with your risk aversion. From there, you will be able to derive an expected target return, which will allow you to stop thinking in terms of percentages and move on to dollars only. That step will derive the minimum capital required to achieve your profit goal and will in turn induce your final position size. To finish, if required, you can then work your way up to tweaking your position sizes on an individual strategy basis in order to make them fit a broader allocation mix in the case of a portfolio of several strategies. The goal being to maximize your synthetic expected risk-adjusted return under your own personal constraints. As you can see, unlike with all the money management pseudo techniques that we discarded earlier, what you should do instead is ground your money management straight into the very risk characteristics of your system and mold it around your own risk aversion. Let's review a real-life example to illustrate this process and show you exactly how it is done step by step. Let's focus on a single strategy first. We will use ES Prodigy, my ES Futures/CFD trading system. An extensive study of that system spanning 28 years has demonstrated that I should be expecting an average annual profit of 807.1 normalized points using a base 2000 and a maximum drawdown of 612.9 points using the same normalization factor. That's effectively an average expected CAGR of 40.3% and a 30.6% max drawdown by default. But that's not exactly what I want. I want to solve my position sizing for a max drawdown of 35%, which is my subjectively designated risk aversion for this system, not 30.6%. To do that, I need to solve the following equation. Position size equals capital times percentage target drawdown divided by maximum drawdown in points divided by the point value. Now please don't jump out the window just yet and let me break it down for you in simple terms. What this little equation does is that it will solve for whatever variable you want it to, given your constraints of course. In this case, we want to extract our position size. We know our tolerable max drawdown in percentage terms, which is 35%. We know our system's max drawdown in normalized points, which is 612.9. And we'll also know our point value, which in the case of E-mini contracts is $50. So now we need to determine our capital before we can compute anything. This can be derived from how much we wish to make per year, and obviously how much we have available. Let's say for the sake of simplicity that our capital is unlimited, and we intend to make an average of $9,000 per month or $108,000 per year with this system. We know that our baseline average annual expected return is of about 40%. Our starting trading capital should therefore be set to $270,000. So now we have everything we need. Our position size should be exactly 270,000 times 0.35 divided by 612.9 divided by 50, which equals about 3.08. So what that means is that we would need to trade about 3 E-mini contracts worth to start with in order to strictly stick to our money management. In our case, since we slightly expanded our max drawdown from the baseline minus 30.6% to minus 35%, we should also be able to proportionately expand our expected CAGR from 40.3% to about 46%. Of course, it goes without saying that this starting position size should be dynamically adjusted as we trade based on the evolution of our equity using a simple cross multiplication. As you can see, except for determining our risk aversion and our dollar profit target subjectively, everything else is objectively quantified here, with zero guesswork involved. And by the same token, we also casually solved another question along the way that many traders have when they start, which is often, how much capital should I start with? As we just did it, this question is very easily answered when you have a working, quantified strategy to work with. The secret here, if you can call it that, is to not put the cart before the horse and expect to get a straight answer without having a solid strategy first. I think it should be pretty obvious by now why it simply cannot be done in that case. Your minimum capital is directly tied to the risk-adjusted return of your strategy, your risk aversion, and your targeted dollar profit. Miss one of these ingredients in the quantitative pot and you won't be achieving much else with your money management than flipping a coin. Now, before we close out this chapter, I want to show you how to zoom out from the strategy position sizing and translate our money management process to a whole portfolio. The process becomes a game of Russian dolls, really, with the portfolio becoming a collection of strategies where each one has been tailored with its own money management through position sizing. For the sake of demonstration, let's consider an extremely simplified portfolio of only 2 stock trading strategies, with each one being fitted with their own optimal position sizes, respectively PA 1 through 10 and PB 1 through 10, with each set of 10 positions being equally weighted in each strategy. Now let's imagine that strategy A has a CAGR to max drawdown ratio of 40/60, while strategy B has a ratio of 30/30. Because these strategies are heavily correlated, you find out that combining them in a portfolio would allow you to increase their average performance ratio to a level that's better than the sum of its parts, a phenomenon that we explained in detail in this video, top right. Quantitative investigation allows you to further discover that an optimal mix would be to allocate 30% of your capital to strategy A and 70% to strategy B. Unsurprisingly, the portfolio's decorrelated risk-adjusted ratio happens to be bumped up to 45/40 instead of a mere arithmetic average of 33/39 that should have come about without the effect of decorrelation. But it so happens that a 40% max drawdown is a tad too high for our risk aversion, which we said we would prefer to cap at 35%. For that reason, in order to narrow it, we're going to have to under-leverage our capital deployment by 12.5% in order to make sure that our max drawdown is kept to that 35% target. Our portfolio's final risk-adjusted ratio therefore becomes 39.38/35, meaning that we can expect to make an average return of about 39% while putting 35% at risk of our high watermark capital. Consequently, the capital allocation in strategy A becomes 0.875 in order to reflect the 12.5% discount, times 30%, our initial weighting, and 0.875 times 70% in strategy B, and our cash allocation logically becomes the difference to 100% or 12.5%. Likewise, each position in strategy A is scaled accordingly and becomes 0.875 times 30% times PA 1 through 10, while each position in strategy B becomes 0.875 times 70% times PB 1 through 10. Now, it may all sound like a mouthful, but all I did really was scaling each strategy and their related positions so that the entire mix fits my risk aversion as a portfolio in the end, nothing more. As you can tell now, money management means little else than quantitatively scaling your capital allocation according to your own constraints. It is highly customizable to both your own preferences and your trading system's inherent qualities. Because of that, it is the furthest thing away from the boneheaded blanket rules and one-size-fits-all nonsensical advice that you keep hearing about online. And best of all, it is quantifiable and objectively replicable without having to doubt anything about its implementation. In fact, right after system design and risk management, money management is the last step that bakes in the control that you acquire over your trading execution. It indirectly takes care of the psychological stress factor by strictly framing the risk to be taken well ahead of actually placing your next order. And as a result, it also acts as the cornerstone of your trading confidence and discipline. I hope this video has made all of this very clear. Further along in this series, we will be investigating how objective knowledge about risk is only one layer of building an ironclad mental stability as a trader. There is much more about mindset and psychology than mainstream trading education will have you believe. And this is exactly what we will drill in our next episode. So take the time to digest this one, and I'll see you there. Stay sharp.